You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have Diageo, Dominos, Heineken, Greggs, ABInbev, and our US company of the week is PayPal. Sam, shall I kick us off with Diageo?
Absolutely. Favourite of the show.
Very much. And a stock, well, one of my favourite stocks in my personal portfolio. It had its 2023 preliminary results out for the year ended 30th of June last week, with full year net sales growing by 6.5% to £17.1 billion on an organic basis. This was driven by 7.3% higher average selling price, which more than offset a small decline in volumes of 0.8%. Underlying operating profit grew 7% to £4.6 billion, driven by higher net sales and growth in all regions except North America. Free cash flow fell by £1 billion to £1.8 billion, largely due to higher inventory levels as the group looks to avoid future supply chain disruptions. And net debt rose from £13.7 billion to £15.1 billion. Organic net sales and operating profit are expected to grow this year, weighted towards the second half, and over the medium term, Diageo expects to deliver consistent net sales and operating profit growth of in the region between 5-7% and 6-9% ranges, respectively. The group also announced a final dividend of 49 pence a share, which was up 5%. Other interesting points from the slides, they commented specifically on the optimization of the portfolio through acquisitions and disposal. They acquired Mr. Black, a leading Australian premium coffee liqueur, Balconies Distilling, a Texas craft distiller and one of the leading producers of American single malt whiskey, and Don Papa Rum, a super premium dark rum from the Philippines. They also completed the sale of Guinness Cameroon, disposed of Archers, and completed the disposal of franchising of a portfolio of brands in India. They also invested in organic marketing by about 5.6%, reflecting strong, consistent investment in their brands, and £1.2 billion of capital expenditure in supply capacity, sustainability, and digital capabilities and consumer experiences. In terms of valuation, Diageo has a market cap of £76.5 billion and trades at 20 times forward earnings, compared with the 10-year average of around 21. It's got a prospective dividend yield of 2.5%, which again is broadly in line with its average. Also to mention, they have a new chief executive, Deborah Crew, and it was after the sad death of Sir Ivan Menezes, who sadly died unexpectedly in the operating theatre from a duodenal ulcer. In terms of the results, I thought they were pretty good, and obviously they've got very strong brands able to benefit from price increases. Volumes not dropping very much, less than 1%. I think that's pretty impressive. We'll come on to ABInbev, but we are seeing that pattern where things are sort of dropping a little bit more in North America. I think these results were decent. I guess the question, as always with some of these quality companies like Diageo, is how much are they worth, and is it 20 times forward earnings? Because that's, at the top end. But if you were to look at these consumer goods companies, I think you'd struggle to get as good as Diageo on the UK market. Very, very healthy margins, and those strong brands, and they follow that theme of premiumization, which is an attractive one. They have an awful lot of the Scotch market, which is massive in both America and in China. So it's certainly, I think they're in a growth industry. And whilst they do have a lot of these very famous brands, in terms of the market share, it's only about 4%, I believe, of the global spirits markets. There's a lot, a long way for them to grow. I'd be very happy holding these shares, but I think it's difficult. You certainly, do need to pay up for them. Sam, what are your thoughts on these numbers and the current valuation of Diageo?
I thought the numbers were all right. They didn't blow me away, but they were okay. it's always a good sign when they're able to increase the prices with a minimal drop in volumes. It does speak to the pricing power. I agree that 20 times forward earnings is quite pricey. However, that's probably the cheapest I've seen it in a few years. Normally it's hovered around 25. So at least it's starting to come down a bit. Although I don't think the share price has dropped that much. It's just that it's grown into its valuation a little bit more, I think, over the last couple of years. It is a business I like. I do like the brands. There is a price at which I would own it, but it's probably quite a bit below 20 just because the growth's decent, but it's 6.5%, 7% a year. It needs to grow quite a bit to justify just the 20 times earnings already. But it is a quality business, and I appreciate you do have to pay up for those. But decent set of results, not amazing. I'd like to see the price continue to get a little bit cheaper, actually.
Then you might take a second look.
Yeah, there is a price at which I would take a very serious look at Diageo. I'm not sure what it is, but 20 is not quite there yet.
Yeah. Well, Warren Buffett has done, or perhaps Todd, maybe. I don't know. He's, I think, a relatively small position, maybe a 50 million or so.
Chump change.
Well, exactly. But
I wouldn't even bother opening a 50 million position.
I don't know whether it's 50 million. It's not a lot.
Personally, I don't invest less than 100 million at a time. Not worth my effort otherwise.
Sorry, in the context of having, what's Berkshire Hathaway worth? 500, 400 billion, 500 billion?
Might be more than that. It might be like 700 now. I haven't looked at it for a while.
Yeah.
Pretty big anyway.
It's yeah. So in that context, 50 million would be very small.
Yes.
Going on to Domino's then.
Yes. So another business that we have covered multiple times. I don't know if I'd quite say favourite of the show, but a business that I've been very positive on in the past, at least. So Domino's, and this is the UK listed Domino's because they are listed on quite a few markets, has come out with their half-year results for the 26 weeks ended 25 June 2023. And system sales were up 7.9% to 766.4 million. Total orders were up 2.8% to 35.4 million. Group revenue was up 19.6% to 332.9 million. Underlying profit before tax was flat at 50.9 million, and statutory profit before tax was up 90.5% at 80.2 million. However, that includes the one-off profit on the disposal of the German subsidiary. So when you take that out, it's actually flat, and it's the same story for earnings per share. The dividend was up 3.1% to 3.3p a share. Domino's have said that the 19.6% increase in revenue was driven by an increase in system sales volume, acceleration of store openings, and the pass-through of food costs. Underlying EBITDA was up 8.2%, which includes 5.3 million of previously guided one-off technology platform costs and no contribution from Germany compared to 1.8 million last year. Excluding one-off technology platform costs, underlying EBITDA would have been up 16.5%. Underlying profit before tax was flat, primarily driven by higher interest costs following the second half of 2022 refinancing. Free cash flow was 56.2 million compared to 36.8 million a year ago, and that was driven by working capital management and robust trading momentum. A £20 million buyback was announced in May 2023, with 13.9 million repurchased at 28th of July 2023. And a new £70 million programme has been announced following the disposal of the German associate, and that will commence when the current £20 million programme is completed. However, this is on a market cap of 1.7 billion, so it's a few percent, but it's not huge amounts. Net debt was 171.4 million, and that gives a leverage ratio of 1.33x, which was below the target. However, that's mainly because of the cash that's come in from the German associate, otherwise it would be a bit higher. But the range is 1.5 to 2.5x, which it would have been in. Year on year, they made gains in the UK takeaway market up to a 7.3% market share compared to 6.6% a year ago. Collections grew to 12.2 million orders, and that was up 20% from a year ago. Delivery orders were down 4.4% compared to a year ago. And they've said the material acceleration of new store openings will continue to reap the benefits of franchisee alignment. So there were 29 store openings in the first half with 11 franchise partners, and that compares to 12 last year with 7 franchise partners. The pipeline is 70% larger than in 2022 across 30 different franchisees. There are 7.9 million active app customers, which is up 46% compared to a year ago. I'm surprised that's up that much because I thought the app was already pretty well used. And app penetration increases with app orders as a percentage of online orders at 75.2%. The successful rollout on the Just Eat platform is complete and continuing to deliver incremental customers and orders. Uber Eats trial is expected to commence in some stores in the first half of 2024. Average delivery times are now under 25 minutes as a result of the franchise partner focus on service and GPS being rolled out to 1,179 stores. One thing that was interesting is they're doing quite well this last year or two. The franchisee trading is quite interesting because it's not quite as good. So in first half of 2019, franchise average store EBITDA was 70,000. That was up to 79,000 a year ago, and now it's down to 76. So it's not like a huge amount of the gains have been passed on to the franchisees. And the EBITDA margin of the owned stores is 13%, and that compares to 9% to franchisees. In terms of valuation, a business trades at a P ratio of 22.59 and yields 2.44%. I really like this business. Last time we covered it, I think it was about 16, 17 times earnings. I think this is a very good set of results. I think the future is quite encouraging. It does look to be a very good set of results, but the market has reacted. So a month ago, you could buy the shares for under £3 a share, and now they're over £4, and it's up 50.25% in the last month, which is basically largely as a result of these results, and that is now reflected in the price. I do like the business, but I think at 22.59, it's starting to look a bit pricey now, which is a shame because it is a business that I really like. John, what are your thoughts on the valuation and the results?
I thought the results were really good. Like you say, it's getting pricier now, and you do wonder how, at what point you reach saturation. And I think with Domino's, and it's Domino's UK that we're talking about, I always feel that we're quite close to that. So I think that would probably stop me from going further with it. And certainly at that more top evaluation, again, I probably feel a little bit anxious with that, and not go further as a result. However, the figures they're putting up are really impressive, and they have done so consistently for a long time. I know Terry Smith, it's one of the companies that he's had, and it's probably a little bit small for him now, if he were going in, because Fundsmith has grown so much. I think it was one of those core stocks that he did have in the original portfolio that helped the outperformance of his fund.
Yeah, I do agree mainly. I think for me, the growth, although it's pretty saturated, the growth targets always were historically modest, especially compared to Greg's, which we're going to cover later. They were only targeting, let's say, a 20% increase in stock. I think they wanted to go from like 1,200 to 1,400 or something like that. And they're well on their way to doing that. But for me, it's a business I like. The targets are modest. It's a good business. There's a price at which I would buy it. But when you're getting in at 22.5 times earnings, there's a lot of growth baked into that price. And I'm not sure it's growth that we'll see. One thing I did forget to mention as well is that they do have a new CEO now. Okay. So they've appointed a guy called Andrew Rennie, and he spent over 2 decades with Sydney-listed Domino's Pizza Enterprises in roles including CEO of France and Belgium from 2006 to 2010. I don't know how that ended up in the Australian business, but anyway, COO and then CEO of Australia and New Zealand from 2010 to 2013, and CEO of the European business from 2014 to 2020. When he was there, the market cap of the company grew from 132 million Australian dollars to 5.85 billion, representing an annualized return of approximately 30%. In a 10-year period when he was in senior leadership roles, the company delivered an annualized return of 34%. During his tenure as CEO of Europe, revenue, EBITDA, and store count increased 4.x, 13.5x, and 3x respectively. I think this is a very impressive resume. I would caveat it with that most of the listed Domino's in various countries have had similar growth levels in the last 10 or 20 years. So I think if you were to look at the American one, it's done similar. You were talking about, the growth of Domino's from when Terry Smith bought. So it's a very impressive revenue, but slightly sugar-coated, I think. But yeah, should we move back to the booze theme?
Yeah, yes. Okay. So we've got Heineken. Again, it's one that we've covered before on the show. They had their half-year results out with half-year net revenue growing by 6.6% to 14.5 billion euros on an organic basis. Double-digit price hikes helped offset a 5.4% drop in volumes. Underlying operating profit fell 8.8% to 1.9 billion euros. That was driven by a decline in the group's most profitable Asia-Pacific region. Revenue growth and productivity improvements were more than offset by inflated costs and increased marketing spending. Free cash flow fell from an inflow of 1.1 billion euros to an outflow of 467 million euros. Net debt increased from 13.5 billion euros to 17.6 billion euros, driven by the cash outflow for acquisitions, shareholder returns, and higher levels of borrowing. In the second half, volumes are expected to improve to a low single-digit decline, and full-year underlying operating profit guidance has been downgraded, now expected to grow organically in the mid-single-digit range. The group announced an interim dividend of 69 cents a share. The shares, as you might expect, didn't respond well, and they were down 7.3%. In terms of the valuation, Heineken has a market cap of 52 billion euros and trades at 17 times forward earnings. That compares with a 10-year average of 20, and it yields in the region of 2%. I thought that these results were, clearly, back-to-back with Diageo were disappointing, and I think it probably is, looking at comparing quality of the companies and the quality of the brands, I wouldn't put Heineken anywhere near Diageo. I know Diageo, it's got its sort of brewing with Guinness, but the rest of it is more of those premium spirits. And I would feel much more comfortable holding those rather than relying on, more of the volume that Heineken's reliant on. It has sort of moved, in recent years more upmarket. It has Moretti, it has Beavertown, but still the price hikes weren't enough to offset the lower volumes. So I'm quite happy with Diageo in my portfolio. I don't think I would go that much further in terms of digging down into Heineken. It's one that we've, covered several times now, and not one that I, each time we look at it, I'm more attracted to. So yeah, I would leave it alone and stick with the high quality business, which is Diageo. And you're not paying a huge amount more for it either, because this is, like I say, 17 times earnings. Or 17 times forward earnings, I should say. Sam, what are your thoughts on Heineken and these figures?
I thought the results were pretty poor. It's not a business that inspires me. I think as a general rule, I'd rather have premium brands anyway. It's not an absolute rule. At the right price, I would buy a business with lower quality brands, for example, with Boohoo. But I'd rather have Diageo's brands than Heineken's. I don't like the product either, which doesn't really, I know it doesn't matter that much as an investor, but I don't particularly like lager, and it's basically all they do. It's just not a business I'd probably want to own at any price, but certainly not on the back of these results, especially, like you say, in comparison to the results we've just seen from Diageo.
Yeah.
I'd sleep much better at night with Diageo in the portfolio than Heineken.
Yeah, no, couldn't agree with you more. Okay, on to a business that historically we've quite liked.
Yes, although not so much the price.
They can't help that.
They can't, that's very true. It's a business as well, initially, where I think we were quite harsh on. We first started covering covering it in the midst of the lockdowns, because so much of their traffic is high street, they'd been absolutely pummeled. I was very sceptical about the level to which high street traffic would bounce back, which in hindsight is obviously ridiculous, but at the time it was a genuine
Didn't seem ridiculous.
No, it didn't, but it obviously was. So Greggs have come out with their first half results, and they've reported first half sales of 844 million, which were up 16% on a like-for-like basis. The start of the year was helped by easier comparisons because of the Omicron variant of COVID-19 a year ago. However, still very, very good results. And when you look at the results for the last 5 years, 2019 revenue was 1.029 billion. Then it was up to 1.167. Then in the COVID year, it dropped to 811, bounced back to 1.229, which is above the pre-COVID levels. And then in the last full year, it was 1.512, which is again well above that. So almost, what was it? Probably about 40% bigger than it was pre-COVID. And then if it's to carry on, it's I don't know how seasonal it is, but you know, if you were to just double the first half, you're at about 1.7 billion up from the 1.5. So it is growing very nicely. Overall, store openings, longer opening hours, and digital expansion all contributed to growth. Higher sales helped underlying pre-tax profit rise 14.2% to 63.7 million. Cost inflation was around 11% for the half and is expected to ease from here. Guidance for the full year is 9%. Group generated free cash flow of 19.8 million, down from 38 million as investment ramps up. There was a net debt position, including leases, of 165.8 million. Not really a concern if the pre-tax profit for the half is 63. Again, if you were to be simplistic, which I like to be, and double it, that gives you 120 million. So net debt of 165 on a 120 million profit. That's not really anything to worry about, I don't think. And we've already discussed their plans are to increase the number of stores to 3,000, and they also want to increase the number of shops that are franchises from 17 to 20%. In terms of the 9% cost inflation, or what they're hoping will be 9% cost inflation for the year. So it's 11% for the first half, but they think for the year overall 9%. They've secured forward cover for food, packaging and energy costs up to early in the fourth quarter. So that does give them some visibility on that. In terms of the valuation, the business trades at a forward PE of 21.6, and that compares to a 10-year average of 22.4. And the prospective yield is 2.4%. My view is this is a business that we have liked, not so much when we first started covering it, but in the last couple of years. I think these are a very good set of results. And when you go back and look at the last 5 years now, it was putting up very good results pre-COVID. It's had the COVID blip and it's just got back to putting up the same kind of results. It's a really, really impressive growth trajectory that it's on. I wasn't sure about the 3,000 store target when they first announced it. I thought it was a bit too ambitious, but if they carry on a few more years like this, they'll soon be there. So at the year end of 2022, they had 2,328. So they've still got some way to go, but it's not ridiculous. I think they probably will do it. But again, you compare that growth, the number of store growth, the fact they're achieving it to what we've seen from Domino's. And I know it's anecdotal, but, you know, last couple of times we covered it, you have made the comment that, you know, you live in the South and you're from the North. Mm-hmm. There is a marked difference in the number of Greggs that you see compared to when you come back up to visit. So I actually quite like it. I think it's a bit pricey, but then if you compare that to Domino's, which is more expensive with slower growth and probably closer towards saturation, I'd probably for the first time since we've covered it, at the minute, I probably do prefer it to Domino's. But that is mainly on price. As a business, I probably prefer Domino's to Greggs, but very impressive results. It's quite pricey, but for the numbers it's putting up and the growth targets that I think it's got a good chance of hitting, it's not outrageous. John, what are your thoughts on the results and the valuation?
Similarly, and I know going back to when we first started the show and covering it, because we did discuss Greggs before that, and it was that, you know, amazing growth story that it had. Not sure exactly when it sort of rebranded, but going from kind of that maybe slightly older person's bakery to then having more of like those kind of sort of slightly deli options, doing, coffee from the bean. And then it was that kind of brand. So it did retain its sausage rolls. Then it had the vegan sausage roll, and then had that more sort of modern, a bit more, a little bit more like Pret, but retained good value. I started going to Greggs a lot more around then. We saw that continue. We had COVID, lots of concerns about everything then. Would it ever return? Would people ever return to the office and kind of casually buy, lunch on the high street? And then we have seen that. I think there were concerns about the valuation, because the share price recovered fairly quickly in anticipation of basically what we're seeing now happening, but that was by no means certain. Now it's continuing to deliver. And again, unlike Domino's, I don't think we've got that saturation, certainly not in the north and particularly in the northeast. We definitely have got that. And you might have, high street with basically 3 Greggs on it. You can't move for Greggs. But in the south, you are seeing them pop up, but nowhere near as much. And particularly with cost of living, you could argue it either way. People may cut down on, buying lunch out. But I think at that more value end, you might end up going from Pret to a Greggs. And I think, like you say, in the numbers, you are seeing the sort of growth continuing. So I'd be quite positive and quite bullish now about Greggs. It's always difficult with evaluation, but I think it's, compared with Domino's, I think it's got more scope to grow. So I would, on that basis, probably choose Domino's over Greggs. Whether I'd be brave enough to pull the trigger, I don't know. Certainly one for the watch list.
You mean Greggs over Domino's?
Sorry, Greggs over Domino's.
So would this be the first time then that you've looked at it and considered it a watch list stock?
I considered it a watch list stock before we started the show. And what's the share? I'm just having have a look at the share price now, because I know what it was when I started many years ago looking. Okay. It's the share price since I first started looking has gone up a fair bit. I think I was first starting looking when it was about sort of £13 to £15 a share. So yeah, it's gone up a fair bit. It's about 26 now. So,
but you would have had to hold it through a pandemic, so you'd have deserved that 26.
I'd have absolutely.
I'd have probably taught you into selling at the bottom. I'd have certainly tried to.
Well, there are a few stocks like that. But then sometimes, even if you're holding on to those things for irrational, there's so much psychology into it. But no, in summary, I like it. Not sure whether I'd be brave enough to buy it, but it's going on the watch list.
Okay. Should we move on to the final of our alcoholic special this week?
Yes. So it's ABInbev, which is most famous for Budweiser. They had their second quarter results out with revenue growing 7.2% on an organic basis to $15.1 billion. And this was driven by price hikes because volumes declined by, just under 1.5%, 1.4%. Revenues grew in all regions except North America, again similar to Diageo, which saw a 9% decline. Underlying operating profits rose 2.2% to $3.6 billion as revenue growth outstripped elevated costs. First half free cash flow worsened from an inflow of $265 million to an outflow of $464 million, and net debt increased from $69.7 billion to $73.8 billion. ABInbev reiterated its previous guidance for full-year cash profits, EBITDA, to grow by between 4% and 8%, with revenue growth estimated to run ahead of this level. And shares were up about 3% on the results. In terms of valuation, ABInbev has a market cap of $112.8 billion, and it trades at 16.6 times forward earnings, which is down on the 10-year average around 20, and it has a prospective dividend yield of 2.2%. And the shares reacted well I thought the results not fantastic. I mean, the revenue growth was a bit ahead of Diageo, but I think one of the things, and kind of the elephant in the room with it, is it has a huge amount of debt, and it's about 3.7 times cash profits at the moment. Company are targeting 2 times. I don't know. I know you've got one of the most iconic brands in the world, and there was sort of that famous Bud Light controversial advert. I don't think we need to go into that. And, some of the maybe traditionally loyal followers abandoning it on that basis. Again, it's not the premium product that Diageo is offering. You can make the argument that you can have, slightly more premium brands within the beers, but it kind of volumes game, and with that level of debt. And in terms of the valuation, I think there's much better growth at a better price coming from Diageo than there is from ABInbev. And the debt is a bit of an issue, I think. Sam, your thoughts on these results from ABInbev and thoughts on the debt and valuation overall?
Pretty similar. I do think it's interesting. I know you've already touched on the marketing campaign that was very poorly received, but North America was the only region that didn't grow. That had a 9% decline. So I think to grow revenue 7.2% in spite of that, I think is actually a very good quarter. However, very similar comments to Heineken. I don't really like the business. I don't like the brands. I know you talk about, one of the best well-known brands in the world, but that marketing campaign does, and the immediate impact on the North American results, it does go to show you do have to take care of these brands, and they're not watertight, especially in such a competitive industry. But yeah, the main issue is just the debt. I wouldn't. 3.7 times is, I think 4 is the point where I get really uncomfortable, but it's close enough to 4 that I wouldn't be happy with it. And then on top of that, it's not a business I'd be interested in anyway. So yeah, I wouldn't take a look at it anyway, but that level of debt would be enough to put me off.
Moving on to PayPal then.
Yes. So this is a stock that I own. So PayPal have come out with their second quarter results, and second quarter total payment volumes were up 11% to $376.5 billion. And all these figures will be in dollars, ignoring exchange rate movements. Revenues of $7.3 billion saw slower growth of 8%, reflecting a continued fall in the total share of transactions PayPal can claim as revenue. Underlying operating profit increased faster than revenue, up 20% to $1.6 billion. That's mainly due to cost cutting. That's a margin of 21.4%, down from 22.7% in the previous quarter. Lower margins on payment processing are one factor behind the trend, driven by the increasing share of unbranded transactions. Free cash outflow was $400 million, and that included a $1.2 billion impact of buy now, pay later loans, which is expected to reverse following the proposed sale of a loan portfolio. Net debt was $600 million, down from a net cash position of $500 million. However, that is on a market cap of about $70 billion, so not too worried. Third quarter revenue is expected to grow around 8% again. Full year guidance on underlying operating margins and earnings per share was reiterated. Share buybacks for the year are now expected to total around $5 billion, up from a previous amount of $4 billion. That's $5 billion. On the current market cap, that works out at about 7% of the shares being bought back, which is pretty good. Oh, and the shares fell 7% following the announcement of these earnings. In terms of the valuation, no dividend, however you are getting the buybacks, which for me is actually better because I don't have to pay the withholding tax on buybacks. And forward PE of 13.6, and that compares to an average since listing of 30.7. I think this is a quality business. Yes, it's got some challenges, but 13.6 for a business of this quality And when you look at the price it was trading at during the pandemic, I don't know if it'll ever get to that level again, but it's down about 75, 80%. You are getting a return of 7% a year through the buybacks. And this is a business that's churning out cash. And even if you think the market share is going to decline, I don't think it's not going anywhere. Even if it stays flat, it's almost getting to a point where the valuation is so cheap that if they just keep buying back shares, you could do very well without the growth. It's just really, really cheap. And for a business of this quality, I don't think they have to do that much for that valuation to seriously change. I last topped up on this business, I think, when would it have been? It was a few months ago, and I wouldn't be against topping up again. I like it a lot. I think it's very cheap. But if it does lose market share, I just think it might be, even if it was a very slow decline, you're almost getting to like a tobacco argument. Because it's already so cheap. Now, if I'd bought it at the height of the pandemic, I'd probably have a completely different opinion if I was down 80%, but I'm only down about 15-20% on it, and it was cheap when I bought it. It does show it can always get cheaper, but I really wouldn't be against adding to this in the near future. So, John, what do you think of these results and the valuation?
I mean, on the surface of it, I think they seem fairly good. I don't know why the market, and I sort of was going to press you a bit further on it as someone who owns the stock. Why do you think the market is responding so badly to it? I mean, is it just that it was sort of priced to the sky and there was a lot of, I suppose, money being invested, Robin Hood, that sort of thing, back in sort of 2020, 2021? Why are we seeing the share price being punished so much?
I think it's partly that. I think it is a good example of the saying that nothing changes sentiment like price, because everyone couldn't find enough reasons to love this business when it was at $300 a share or whatever it was.
Yeah.
Obviously, Apple Pay and Google Pay are increasing their share of the market. I think that's the biggest issue addressing PayPal, but it's got so many avenues to grow. It's got so many things it could still do with a wallet. It's not like this is a declining business, and it's priced as if it is. It grew 8% this year.
Yeah.
And it's saying for the next quarter, it expects the same. I know part of the increase in profits is from cost cutting, and they can only do that for so long.
Yeah.
But you just get to a point where it's almost a lot of the arguments you would make for a tobacco business, you can start to make for PayPal, which is ridiculous considering the quality of the business. But yeah, I don't know. I think it's partly just the price, but I think it's Apple and Google Pay. So I think the main concern is not what's in the results, but like what that slowing revenue could represent. And I think the concern is that could very quickly become declining revenue rather than just revenue that's only growing 8%. But I just think it's a business that's way off of that.
Yeah. And it's interesting just thinking about us as consumers, because I used to walk around with a wallet, I'd have several cards in it, and I wouldn't go anywhere without it because you need it buying coffee, doing whatever you're doing. Now, I basically just go everywhere with my phone, and everything, or almost everything, just goes through Apple Pay on a day-to-day basis. And that's where I'm at, at home, abroad. I don't know whether it's like that for you, Sam, with sort of Google Pay or...
Yeah, so when I'm out and about, I'm mainly use Google Pay now, but I still use PayPal a lot for online shopping. It's probably not as high as it was, but I still use it a lot. And I think in the last set of earnings, I think the average PayPal user uses it like something like 50 times a year.
Yeah. And why
is very sticky. Yeah.
And why do you use it out of interest when you're online?
When I'm on, it depends what I'm buying. Yeah. But so I use Google Pay, and that's linked to my Chase card. Okay, but that's a debit card. Yeah. So if I'm buying something online and I want the protection, I'll either use my credit card instead with Google Pay, or I'll just use PayPal, because you get a very good level of protection from PayPal as well. Okay. So it's because it's for something where I don't want to use my debit card. I'm slightly biased in that if I'm choosing between the credit card and PayPal, unless it's something like a holiday, in which case it goes on the credit card, I try and use PayPal because I'm a shareholder. So I maybe use it slightly more than I otherwise would. Okay. But I basically use it where I don't really want to use the debit card.
Fine. Okay. Interesting. I used to use it, maybe for eBay, but obviously they, they're all separated, and now it's not on eBay, and certainly not as a default. But I would just use a credit card for
But if I
that
use
sort of protection.
But with the Chase, it's not just because obviously with the Chase, because I'm in that first year of having the Chase card, I get 1% cash back on everything. But I've got the Chase card inside the PayPal.
Oh, I see.
So I'm still doing what I'd be doing anyway, but I'm just adding the PayPal protection on top and getting my 1%. So that's when I mainly use it.
That's okay.
How that'll change once I get outside that one year window where I stop getting the 1% cash back, I don't know.
Yeah, but these are some things that
But it does show, though, it does genuinely still have a purpose.
Oh yeah, it does. It does. I would agree with you there. So no, it's probably not one for me, but I do see the I guess a value argument with PayPal. But
I think it is value at this point.
Yeah, which is crazy. And you look at the average forward price to earnings ratio since listing, it's over 30. It's crazy.
Is there a price at which you would buy it? Or is it just not a business you'd ever be interested in?
I don't know. I do worry about those other things, like, just anecdotally, that I'm basically just using Apple Pay for everything.
Yeah, but you're Apple everything. You can't use yourself as an example.
Well, okay, I'm Apple everything, but you see how many people are paying on their phones for things.
But how much of that is just replacing debit and credit card transactions that was never going through PayPal anyway?
Yeah, but it comes up. I don't know with you with your sort of your Android wallet, your Google wallet, that when you're coming for like an online transaction, more and more you can just pay with like Apple Pay or the equivalent with Android. Is that not? Do you not see that?
No, yeah, I do. Yeah, and I do use it
because it's like, for me, it's 2 clicks and like scan your face and Face ID are off, and I don't know.
Yeah, it is ridiculous. Like, I was ordering some photos the other day, and I was doing it with Millie, and we were going through it. We picked the photos we wanted, and because it was Google, because it's like, obviously it's linked to the albums, and then you just click it and they just post you the photos.
Yeah.
It was like 2 clicks. You didn't even have to confirm anything because they've already got you in Google Pay. And it was almost like, I was a bit like, what's happened here? It was fine because I wanted the photos, but I was like, why was there no, like, normally you get one last chance, like, confirm or like, and it didn't even do that because it already had everything. And she was just like, well, that's like, you hear the stories about when kids go on the parents' phones, and because it's all through the Play Store, they just spend like $1,000 on like 3 albums in this game. And you can see how they do it. It's just so easy to spend.
Yeah. So
anyway, I don't think it's going anywhere though, but I do think the future's maybe a little bit less rosy than the past, but there's the price.
And what can they do about that? Maybe it is moving to the other avenues. Maybe they genuinely innovate. I don't know.
Yeah, well, they've got like the buy now, pay later stuff. They do have, and like you could buy like crypto and stuff in there, but you could potentially turn the wallet into almost like you can buy other stuff, like a free trade inside there. I don't know if there's like regulatory issues with that, but that's something they were talking about, like doing a super app at one point.
Yeah,
but just when you've got that many people spending money on it, it's kind of like, I know it's not the best example because of the share price, but when you look at Hargreaves Lansdown, it's like they've got so many people locked into the system with the shares. It's like, well, let's throw them a cash ISA. Let's do this. And you've got all that money already in your system. It's very easy to offer these auxiliary services that just go straight into profit.
Yeah. No, fair enough.
We'll see, though. But I think it's like a 50 times earnings. I wouldn't buy it in this, with these issues. But at 13, I'm happy to take the risk.
Fine.
So of the 6 businesses we've talked about this week, Diageo, Dominos, Heineken, Greggs, ABInbev, and PayPal, which do you like the most and which do you like the least?
I would say Diageo is the one I like the most. The one I like the least, probably go ABInbev. Domino's, I don't dislike. I just think it feels like the UK market for an excellent business, but is reaching that saturation point, and that would be my concern with it.
I think PayPal's probably the one I like the most. I know we're showing biases towards our own stocks here, but ABInbev was the least. It would have been ABInbev or Heineken, but the debt seals it for ABInbev. If I wasn't allowed to choose PayPal on the basis I own it, I would probably go with Greggs.
Very good. Well, Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.